hint, that's a little bit of the topic that I'm going to be speaking with you about today. But currently living in sunny Phoenix, Arizona. I know quite a few of you, I think, are from Phoenix. So hello. We love living in Phoenix and are just having a great time kind of getting to know the area. So today, I'm going to talk to you all about investing out of state. I know many of you are also from California, I think I hear, and then also the Phoenix area. And so if you've been paying attention to what's happening in the local markets, it is incredibly difficult to find deals that make sense for cash flow. And also, just in terms of getting into properties in these areas, it's very competitive. And so I started investing in 2007 in Seattle. Really, I would say spent almost the first, 8 or 9 years just investing locally in my own backyard. And then when the deals no longer made sense in my market, I started to explore other areas. And nowadays, I only invest out of state. I am now in 7 different markets. I'm sorry, 7 different states. I'm in, I believe, 10 different markets. And that's changing every week as I get more properties under contract. And so that's what I wanted to talk to you all about today is what I'm seeing in terms of markets that I feel like are viable strategies for long-term buy and hold that offer long-term appreciation and instant cash flow. So I'm going to share with you guys kind of my framework around how to do that. And then also how to invest and scale up while not spending a whole lot of time doing it. So when I started this call, I mentioned that my family and I travel quite often. I maybe spend 5 hours a week on my portfolio. My husband and I own over 260 units across 7 different states. So I'm very much excited to sharing with you all.
Oh, Jennifer, do you want people to take themselves off mute and ask you questions during your talk, or would you like to hold them to the end? I usually say put them in the chat and then I'll judiciously interrupt you, but how would you like to work it?
Yeah, I think some of the questions may be answered in, another slide. So if you wouldn't mind, it'd be great to have the questions in the chat, and then we can do Q&A at the end, if
Sounds
you all
good.
are okay with that. Yeah,
Sounds great.
excellent.
So put
Okay,
your questions in the chat, everyone.
excellent. And I'm gonna have to apologize for my voice. I'm kind of getting over a bit of a cold, so yeah, just a little bit under the weather, and sounding a little a little scratchy today. All right, I'm going to see if I can share my screen here. I believe it is, let's see, is it open share tray? Screen share?
If you look, see the big red leave button in the upper right-hand corner? There should be an icon right next to it that has an up arrow.
Okay, I see an up arrow.
That's your share content button.
All right, we will try this, and then I'm going to go over here. And if somebody could tell me, or Daniel, if you could tell me, can you see my screen?
We can.
Excellent. All right. Fantastic. Well, the title of my session is How to Fund Your Best Life Through Out of State Investing. And I like to use this great visual. This is a photo of my husband and daughter and I just actually a few months ago. This is in November when we were in this is Giza here in Egypt, and we had spent about 4 months traveling Europe, and of course, heading over to Africa this summer, while continuing to invest and while continuing to own and operate our portfolio. And so, really, my whole reason why I started investing was so that I could have passive income coming in, no matter where I was in the world. And that was really kind of the basis of building my portfolio and the framework that I'll be sharing with you today. All right. So as mentioned, it's all about building a system for investing from anywhere with I would say, minimal effort and maximizing the returns. So these are just some fun trips from our travels over the last couple of years that, to be honest, have all been made possible from investing in real estate and having these passive income coming in. All right, but I want to take you first back. The call that started it all I feel like for each of us, there's inflection points in our lives when we start questioning maybe some of the decisions we've made or even the trajectory that we are on. And the call that started it all, as mentioned in the beginning, my husband and I were local investors to begin with. We started in 2007, made it through the Great Recession, and then started buying quite a few properties as prices were going down and things were becoming more affordable. And my husband was able to retire at 30 years old because we had replaced his entire salary from the cash flow coming in from these rentals. But unfortunately, thank you. But unfortunately, he retired from his W 2 and then found himself a job managing and operating all of our rental properties. And this inflection point in our lives happened. Of course, I'm sure you've all heard the stories of, people saying, well, I don't want to be the landlord that gets the call at 2 a.m. that, something happened at the property. Well, that had happened to us. It just wasn't 2 a.m. It was Sunday evening when we had a large barbecue at our house over Memorial Day weekend, and a tenant called and they had some major plumbing issues. Unfortunately, this is one of our properties that had a septic, and the septic was coming up through the bathtub and essentially starting to flood the property. And so, sure enough, my husband had to leave the barbecue that we had and kind of deal with this situation. After everyone had left, and after, of course, he had come home, we sat down and said, I think we're doing this wrong. We have built this portfolio. You've retired early. However, you may very well be working as many hours or having as much stress operating our portfolio as you did when you were working a W 2. So something needs to change. And there were a couple of options. I mean, option number one is we could have stopped buying and said, okay, we're going to keep what we have, turn our rentals over to property management, and just stop there. Another option was, well, how do we make this more of a passive investment? How do we, in some ways, move from operator to investor or business owner? And so, what that led us to was actually considering where else we should be investing. In some ways, I will say we had to think about how we could protect ourselves from ourselves. It was almost just too easy for us to, find our own properties locally, operate them, bring our construction crews in and do this. And so we said, well, what would it look like if we were to invest in other markets where we wouldn't be the one to get that call? And even if we did get that call from the property manager, certainly we wouldn't be flying out to these other markets and taking care of these things. And so that led us to out of state investing. But really, it started I guess I want to kind of pivot this over to you all is, my first step that I recommend for any investors that are thinking about investing in real estate is number one is you have to know why you're doing this. What is the purpose for investing? Is it to build long-term wealth? Is it to get instant cash flow? Maybe some of you are thinking about a retirement strategy that's outside of the traditional retirement strategies, the 401ks, the pensions, Social Security, things like that. Is it to leave assets to your children, right? I mean, everyone has a different reason why to invest. There's certainly also a lot of other investment vehicles other than real estate, but for us, real estate was the quickest path to quote unquote early retirement and not having to work a W 2 and getting these passive income streams coming in from wherever we were. So, number one is really developing your investment criteria. And we had to go back and change our investment criteria in some ways because we were just so efficient in our local market. But in order to scale that and to go into other states, it was really getting clarity on exactly what kinds of properties we were looking for, the returns we were looking for, so that we could communicate that to our boots on the ground, these real estate agents and potentially wholesalers and property managers, so that they knew exactly what we were looking for so that they can go out and find those deals. And I want to give you just kind of some very basic criteria. A lot of investors come to me and they say, I want to make $10,000 a month in, this passive income, quote unquote passive income, and I want to get there in 5 years. And so just really basic framework for that. This is actually my criteria. I look for properties that have $250 per unit per month in net cash flow. That is after all expenses, including reserves, including your operation expenses, property taxes, insurance, property manager, capital expenditures, repairs and maintenance, of course, assigning vacancy rate, paying the mortgage, and everything like that. So for someone that had this goal in mind, $10,000 a month in 5 years, it's really buying either one 8-plex a year or buying two 4-plexes every year for 5 years, which is actually, it sounds incredibly simple, but we have investors doing this all the time. It's very, very, even in today's market, pretty easy to hit these numbers. I search for B, C plus class value add multifamily in growth markets, meaning where people are moving to, not leaving. I like to invest in properties that are 1970 or newer, where I can achieve at least double-digit returns. Oftentimes, we're able to hit that, pretty quickly and also get well over 10%. But when you get into B class, the returns tend to be a little bit lower because it's lower risk, right? So risk reward there. All right, so the $1 million question is, where are the best areas to invest? So when I asked myself this years ago when I started investing out of state, I really looked at just a few pieces of criteria. So number one is I determined that I wanted to invest in markets where there's a lot of inward population migration, meaning more people are moving there versus leaving. And I have just kind of a fun extreme graph on this. This is two different graphs. The one on the left is Clarksville, Tennessee, and my guess is most of you have never heard of Clarksville, Tennessee. Clarksville, Tennessee is about 45 minutes. It would be, let's see, it would be northwest of Nashville. So it's in, really, really close to Nashville there. And the population growth is about 47%. So almost, doubling the population growth between 2000 and 2017, which is the last census data. A lot of population growth. And then here on the right-hand side, you see Detroit, Michigan, right? This is a market where over 1 million people had left in about I think it was a 15-year span. And so for me, it was very obvious that I wanted to invest in markets where more people are moving to versus, leaving from. And the reason for that is obviously, if you're looking for any long-term appreciation or forced appreciation through these value-add multifamily properties, then you need to be in markets where you have a lot of tenants moving there, long-term appreciation, right? More people moving there, meaning that some people are going to be buying houses. There's going to be some growth there. A lot of times when people are moving to a market, it means that there's availability of jobs, higher wages, all of those kinds of things. And so I avoid markets where it has a declining population. Some examples of that would be Birmingham, Little Rock, Cleveland. Not necessarily my favorite areas to invest, or not areas that I'm really considering because they have a declining population. I also look at things like crime rates. I like to invest in areas where there's a lot of job diversification. So maybe not a one industry or a one employer town. That's the downfall of Detroit. It was predominantly the auto industry. And when the auto industry struggled through the Great Recession, a lot of people left because there were just no jobs, right? And so I really pay attention to the trends, the economics, and the demographics of these areas, and really kind of hone in on locations that I feel like could be good long-term investment opportunities. And then next is building your team. So I feel like it's a different level of leadership when you are working with people in local markets, potentially that I've invested in markets where I've never been to, or I've never met these people in person. And I'm solely relying on their word that this neighborhood, this area, this property, is a good representation of kind of what I'm looking for, right? And so I included this photo because it was really fun. This is actually my Clarksville agent there. Just the one with the brace on her leg there. And how I find team members in other states or agents is in a couple of different ways. Kelly, I actually just went on realtor.com and I sorted all the multifamily listings, and I made notes of the agents that had a majority of multifamily listings. And so you can do the same on LoopNet. on, commercial MLS. There's a lot of different ways that you can get this information online. And I noticed that she had, I think, maybe 20 multifamily listings. And so she was, in my eyes, from what I could find online, the top multifamily listing agent in that market. And I just called her and said, I am looking for multifamily in your area. Can you kind of tell me a little bit about the market? Can you tell me what the going cap rates are in your market? Had a great conversation and have purchased quite a few apartment complexes from her and helped other investors get into that market. So sometimes just make a couple of phone calls and see who you can find. Of course, you will need a property manager. So property manager is incredibly important to making sure that these investments go well. They're going to be staying on with you long term. And so a lot of times I will build a team. If I find a great investor agent, I will say, do you have property managers that you work with? And then I'll start interviewing property managers in those markets until I can find a good one. But it's really important to find those. Now, how do you vet these people, right? As mentioned, I've purchased multiple properties in Clarksville and had never been to that market, have never seen these properties. And so this is kind of my vetting process. Number one is if you can get referrals from other investors that are already working with these agents or property managers, that will always be your best resource for getting great people. Number two is always get multiple opinions. So when I'm purchasing a property sight unseen, or maybe I'm out of the country writing offers, of course, I will talk to the agent. I will call, if it's a new market to me, I will call about 4 different property managers and get their opinion on the property, opinion on the deal, opinion on the area. Of course, the home inspector, the insurance. Sometimes I'll call local commercial lenders and get their take. And so I don't only ever rely on just the agent's opinion. I get multiple opinions from multiple different people in that market about that deal, about that neighborhood. And number 3 is I always follow a due diligence checklist. And if anyone's interested, I'm happy to share ours. It's about a 3-4 page due diligence checklist going through, and I'll kind of do a little bit of a deeper dive here in a minute of the things that I look for and look at when investing in these markets. And then number 4 is trust your gut. If something doesn't seem right, or if the numbers seem abnormally high, or the returns are incredibly high, then dig in there and just really make sure that you're doing a full due diligence on these properties so that you really know what you're getting into. And just trust your gut. So if it doesn't feel right, then it's absolutely okay to walk away from a deal. I would rather lose a good deal than buy some bad deals and then try to get out of it. Oops, the other way. All right. So in terms of due diligence, I kind of look at it in 2 different ways. There's financial due diligence. Oh,
Yeah, what?
I think we might.
Yeah, I'm going to go through and try and mute people.
Okay, no worries, no worries. All right, so financial due diligence. This is where you get into lease audit and going through the operation statements. I often, request and ask for a trailing 12 months of profit and loss statements, going through all information about these properties. Obviously, smaller properties, maybe single family duplexes, up to 4plexes are a little bit easier if you're just getting started because there's fewer units, there's often fewer moving parts. It's a little bit easier to go through those. But on the larger units, you've got multiple leases, multiple moving parts, and so financial due diligence is incredibly important. Typically, when I'm writing my offers and negotiating these contracts, I will require that I get all of the financials from the seller before moving to physical due diligence when I'm going to be spending money on inspections and surveys and things like that. All right, so physical due diligence. This is a photo of my daughter. We actually pay our daughter to do, she's walking Google Earth here on a property. We like to, bring her into the business. Of course, we pay her through the rental properties and it funds a self-directed a Roth IRA. But really making sure, we use Google Earth a lot. We use photos, video, a lot of different things that we get to kind of get an idea of the neighborhoods that we'd be investing in. And then, of course, we always do, home inspections, get inspectors out to go through every single unit, check out the HVAC units, the roofs, exteriors, all of that. We also do sewer scopes or sewer laterals on every single property because we just want to make sure that, again, we know what we're getting into and we don't have any surprises after closing. All right, so some lessons learned the hard way. Number one is in the beginning, I would say that we under improved our properties. I'll give you guys an example of that. So we might have saved the original 1970s cabinets and put new flooring. And then a couple of years later, when the cabinets were falling apart, the flooring wasn't in the same, I guess, layout. And so we were redoing the flooring. So we found that by going cheap, in the beginning, that it actually cost us more in the long run because we were re-renovating a couple of years after the initial renovation. So these days, if we're doing a heavy renovation, we just do everything up front. There's also some tax incentives to do that. And so nowadays, again, we just get everything done right up front. We rip that Band-Aid off and make those improvements. Number two, I would say, is losing money on inspections. So it's very common with, multifamily properties. If there's tenants in there, that the seller will require mutual acceptance before you can get inside the units. So again, not only are we buying sight unseen, a lot of times we don't have interior condition photos or things like that. A lot of these deals, I should mention, are off market. And so, we're getting direct to seller, we're getting better prices than what we're finding on the MLS. And in some ways that comes with more kind of unknowns. And so typically what we do these days is we'll get mutual acceptance, but we'll write and negotiate into the contract that we have 48 hours to do interior viewing or previewing with either our property manager or our agent before we get to physical due diligence and starting to spend money on inspections. So that's something that you guys can take with you. Number three is, again, in the beginning, as investors, we were doing a lot of flipping of properties versus holding. And I also have a background in new construction developments. And so my husband and I would build spec homes in Seattle and sell them. And the profits were fantastic, but it was a one-time profit versus a lifetime of cash flow, which is our strategy now. And so I feel like some investors say, well, should I flip to then fund the long-term buy and hold? And in my opinion, that is kind of going the opposite direction of your goals. If you want the passive income coming in, these income producing assets to pay you regardless of where you are. And so I would advise you to not flip. Instead, if you like that activity, then flip to rent, meaning buy a fixer upper, fix it up, put a tenant in there, refinance it, and then hold it long term. And then eventually you can take cash out refinance. It's tax-free money when you put it into your bank account. And so you don't have all the taxes that comes with flipping, and you can still own the asset. Number four is not defining roles or I would say setting expectations with the property managers on the level of renovation that we want with these properties. It's very important to make sure that there's a clear definition of roles of who's doing what. If we're managing a renovation from afar, if the property manager is renovating a property for us, acting as our project manager, it's really important to kind of know that up front and then look for the property managers that do offer that as a service. Also, we have gone in kind of different stages of the journey where at one point I thought that it would be a good idea to start paying down all the mortgages with the excess cash flow. And when I actually had done the math, we probably did that for about a year and had significantly paid down some properties. But reinvesting, especially with this inflationary period that we're at right now, where inflation is so high and rents are so high, yet mortgage interest rates are still so affordable and still so historically low, I was leaving return from the table. And so we no longer do that. We use all the excess cash flow to reinvest into additional properties. And then last but not least, trying to time the market. I was convinced in 2017 that the market was going to crash in 2018. And here we are today. I think we've probably seen maybe, in some markets, 30 to 50% price appreciation between this period of time. And so I just realized that trying to time the market is not a viable strategy. So today, it really doesn't matter to me what's happening in the economy, what's happening in the stock market, what's happening with inflation. It's all about finding value add properties where we can go in, improve the units, get higher cash flows, maybe take some cash out refinance and use that to roll into the next property, but still have a low LTV at the end of the day and high cash flow. So I no longer try to time the market. All right, so and I just kind of wanted to move to, and let me check the time. Okay, excellent. Just some case study examples to kind of maybe show you guys a little bit about what this looks like and what types of properties. I'm just going to show you some of my recent acquisitions to just give you an idea of what this looks like. I like to categorize the markets into different categories related to cash flow and appreciation. As mentioned, I own in 7 different states, and so I like to have a diversified portfolio across different locations, across different asset classes, and different asset types. So this is a 34 unit. They're actually doing due diligence today. So the off market, I got it under contract for $1.6 million purchase price. The net operating income, so this is the net income, not considering the debt payments, it's about $138,000 a year. Should produce about $5,600 a month in cash flow. That's about a 13% cash on cash return. But the benefit of investing in multifamily properties is once you improve the net operating income, then you can, assign the current market cap rate and essentially force appreciation. You can't necessarily do that with residential because residential will only ever be worth what other surrounding residential properties are worth. And so once we do a couple of things here to this property, we can, push it up almost instantly to a 1.7. And there's not a whole lot that we need to do here. We just some laundry room cleanup and taking care of some of the exterior doors and things. Here's another one. I just closed on this one mid-December. It's just a small little 7 unit. This is in Holland, Michigan. This property is about a mile away from the lake there. So really nice area. This property was built in 85. So this is going to be, maybe average cash flow, average appreciation. I purchased this one for $775. Also received some cashback credit from the seller at closing. About $2,700 a month in cash flow. It's about a 12% cash on cash return. The rents were about $850 when I purchased it. Fair market rents are $1,200. We don't have to do a whole lot to the property, just a few little cosmetic things here. And then we'll be able to drive the value up about $200,000 on this property as soon as we get those rents bumped up. This is another one. It's Clarksville, Tennessee, the example that I had showed you all earlier. This is an 8-plex. I consider this a high cash flow market and a high appreciation market. I purchased this property maybe about 2 years ago for $500,000. The cash flow is about $1,845 a month. It's a 17% cash on cash return. But today, it's about worth $800,000. So $300,000 in 2 years, not not bad on the appreciation side. This is another market, but Tennessee is probably my favorite state to invest in right now, just because of the inward population migration. There's so many people moving to Texas, Tennessee, Arizona, the Carolinas as well. But this is just a little duplex. So as mentioned, I own a lot of different asset classes. I also own larger apartment complexes and smaller. It's just the duplex that we picked up a couple of weeks ago. This one's 118,000. We did put about $13,000 into the renovation. It'll be about $453 a month in cash flow. This is about a 29% cash on cash. As soon as that we have a few things to do on the other unit there, and then we'll refinance this when I just paid cash for, but we'll refinance this and it should be worth about 180,000. So small deals work too, if you're just getting started. And this is another one. This is a unique, actually, I think all of these deals except for the Holland deal were off market. I had a builder developer reach out to me and offered, oh, here's someone in the background, offered for me to buy the entire neighborhood. And I'm so disappointed that I didn't. This is an entire neighborhood of pre-sale off-market duplexes just outside of Boise that he was selling. So I grabbed one and helped all of my investor friends grab the rest of the neighborhood. So we kind of own this neighborhood. This is a $385,000 purchase price for this duplex. Again, brand new construction. We ended up renting each unit for about $1,800. So it's about $900 a month in cash flow, 10% cash on cash, which is really quite high for brand new construction in, one of the also the hottest markets in the US. And instantly after closing on this one, we got instant equity. So if I were to sell this today, it's going to be anywhere from the 550, probably actually sell for 575. So again, for those of you that are thinking multifamily might be a lot larger, or I'm just not ready for that yet, small properties work too. So again, as mentioned, I will buy small properties, I will buy large properties, really just, kind of whatever works right now. All right. So some common mistakes that I see investors make when they start investing out of state. Number one is not getting enough opinions. I had a friend of mine who was buying, let's see, it was a 10 unit in San Antonio, and he got the deal off market from an agent, ended up paying cash, closing on the property, and then calling property management after closing. Four property managers said that they would not manage in that area. That is not an area that he should have invested in. And unfortunately, he's still trying to turn that around. He just didn't call property managers, didn't get anyone else's opinion other than the agent who said, this is a great area, this is a great deal. And unfortunately is now kind of trying to, get that one under stabilized and under performance. Number two is sticking with poor property managers for too long. I would say I've gone through, actually, I've only probably fired two property managers in 15 years. So it's not too bad. But I see some investors, where they say, well, it's been 4 months since it's been listed and we don't have a tenant yet. In most markets right now, I mean, if you're not finding a tenant within probably 3-4 weeks, something is wrong. And so sticking with a poor property management for far too long is just not going to be a good long-term deal. So if you're not having great success with the property management company, or a deal, the first thing I tell the investor is to start calling around and finding a different property manager. And if a new property manager can't get that asset stabilized or under performance, then it might be time to sell. But always look at the current property management. And then number three is just not trusting your gut. So if something doesn't seem right, such as my friend who was buying the 10 units, the returns were fantastic. The numbers looked too great. I think he didn't want it to not work out. So that's why he waited until closing to call the property manager. But really just trust your gut and make sure that you're just going through all the due diligence. And then number four is lack of area due diligence. I've seen a lot of investors invest in Detroit, in Milwaukee, in some of these markets that I would say are maybe D-class neighborhoods, and just not doing a whole lot of due diligence there, not talking to multiple property managers or waiting until after closing to talk to property managers. And so, so that's a big issue. You really want to trust that property manager, get multiple opinions, and make sure that you're investing in the right area. So I'm just going to put, if anyone has questions or if you want my due diligence checklist, I'm happy to help. There's my email there, and also my website. But otherwise, I'd love to just open it up for questions. If you all have questions, I can see about.
Yeah, there's quite a few questions.
Oh, excellent.
Would you like me just to start at the top and bring them one by one?
That would be fantastic. I'm going to stop. I think I stopped sharing my screen there.
You have. Yep.
Okay, excellent.
So Gary says, I like $250 per unit per month, but what's the lowest monthly return you should consider?
Oh, so it's very much to your personal opinion. I would accept a lower price per unit for a or B class, or certainly if I were to find, I'm still looking for deals in and around the Boise market, and I would accept a bit of a lower, price per unit cash flow in markets like that. But I would say maybe around 200. But again, it's very much dependent on, your why for investing and what your long-term goals are.
All right. Glenn and Rowan have about the same question here. And the question is, how do you finance your properties? Are you dipping into equity of your current properties? Do you have a good loan broker? How do you go about financing them?
Sure. So I no longer meet the conventional lending criteria because we have so many properties. But I work with a couple of different commercial lenders. My favorite right now is Certain Lending, CERTAIN, certainlending.com. And they will do 30-year fixed 30-year amortization. Interest rates have just gone up, so I think they might be in the low, maybe 5% right now. They will do loans in LLCs. These are portfolio loans, and they will go up to 20 units. And so, for those of you that maybe don't fit in that conventional box, certain lending is a fantastic option. They will also do 20% down on, say, 2 to 4 units, and also these larger portfolios. Whereas, if you were to go to a conventional lender will often want 25% down. So you actually have the benefit of 20% versus 25. So certain lending is
Did
fantastic.
did I get the right URL in there?
Oh
Certain.
yeah, I see it. Yes.
Okay,
Perfect.
good.
Excellent.
All right. Next question is, can you provide inputs on how to find duplex or fourplexes in good markets? Is there a specific website or another way to look?
Oh, I wish there was one centralized database for all deals, but I haven't found one yet. And so I actually get all of my deal flow from real estate agents. Um, I could probably build a team around, sending letters and cold calling and maybe door knocking all of these markets. But to be honest, I want to spend as little amount of time as possible on building and scaling my portfolio. And so I've identified that real estate agents are out there doing this all day long. And so if I can just get in touch with these investor savvy agents that are already out there finding deals and become their preferred investor, then I will get all these deals from them. And so essentially that's what I've done. And so it really is going to, again, kind of go back to your goals of what types of deals you want to do. But my recommendation would be to maybe identify 2 to 3 markets and then go about searching for, real estate agents in those markets that have multifamily listings or maybe come by referral from another investor and start developing relationships with them. Right now, real estate agents are very, very busy because everyone wants to get into this hot real estate market that we've been in. And so, my recommendation would be to get pre-approved, right? So work with a lender that maybe can do loans in multiple states or certain lending. They're in, I think they are in 47 states. And when you go to this agent, tell them exactly what you're looking for, your budget, show them that pre-approval letter, and then just ask them, what can I do to get to the top of your list so that I'm the first investor that you'll call as soon as you get a deal that meets my criteria?
I'm going to ask a follow-up question to that. Certain lending, what's their pre-approval process? Is it like a bank or do they do something different?
Oh, yeah, yes, I'm so glad that you brought that up. Yeah, so they are an asset-based lender, which means that they underwrite based on the debt service coverage ratio of a deal. Now, you don't necessarily need to know all about that. You don't have to be an expert at deal analysis, but essentially they want to make sure that the any property that you're buying has at least 25% more revenue than the new debt payment. And so the debt coverage ratio that they're looking for is 1.25. Outside of that, typically they will run a credit check, but it's not going to be the conventional lending standards that you're used to, such as pay stubs and multiple bank statements and letters of explanation for why you lived in one city and then you moved to another city and things like that. They're really mostly looking at the deal versus you as the investor qualifying for that deal, if that makes sense. So it's almost the opposite of residential lending standards, where it's all about your debt to income ratio. For them, it's the debt service ratio of the property. But the pre-approval, Alex and me over there, there's a couple of different ways you can go about it. One is you can just schedule a call with them, kind of give them an idea of what you're looking for, and they'll give you some set of criteria. Or you can, if you find a deal that you like, you can actually submit it on their website. It takes maybe 3 minutes. And then within a couple of hours, you'll get a term sheet back from them. So similar to working with these commercial lenders. And they'll give you a couple of options. You could certain interest rates. You can do buy down points if you'd like. And so they'll just give you a bunch of options.
Sounds like they run it very much like a commercial lending operation.
Yes, absolutely. But the benefit is they'll do residential properties and up to 20 units.
Huh. All right. Jane is asking, do you have any tips for vetting contractors?
Oh, contractors. Yes. So So contractors, and just to keep in mind, almost everything we buy out of state, we are renovating. And so we're doing a lot of renovations, which is actually great because that's kind of what we get. We get points, and we put things on credit cards and pay them off every month, so that we get airline points to travel to Europe in business class for free. That's a whole other strategy for another day. But vetting contractors, typically we get our contractors from our property managers. And so when I'm calling around for property managers, I will ask them, do you offer project management for out of state investors? And some don't. Some say, nope, that's you as the investor. You are to deliver us a property and we'll fill it with tenants and we'll operate it from there. We'll maybe help with the make ready. But some property managers will not take on a full renovation project to get the property stabilized to then put tenants in. And so we call around until we find a property manager that says, yes, we offer project management. Most times they charge an extra percentage for that. It can be anywhere from 5 to 10% of the renovation budget. And then they will be our eyes and ears. They will manage these projects for us, and they will find us contractors. They will bring us bids. A lot of times we're getting maybe 2 to 3 bids per project and then deciding which contractor to go with based on that. And then the property manager goes out every single week, sends us photos of what's going on, and then maybe we'll submit a draw and then we'll pay them based on that.
All right, Glenn is asking, how much money do you usually put down on a property?
I would say usually 20 to 25% on some of the commercial deals. Um, Lately, the commercial underwriting has gotten a little bit more strict. And so sometimes we have to put 30% down. But yeah, I would say anywhere from 20 to 30%.
Uh, Surya is asking, what's the second lender? You mentioned two lending companies.
Oh, sure. Yeah. So certain lending. And then also just a lot of times we're working with small regional banks. I've also worked with loan brokers in the past. So a commercial loan broker is somebody that will, you'll have like one point of contact, submit a deal to them, and then they will pitch it to multiple banks and bring you back a set of terms from maybe a few banks, and then you can choose which direction to go from there. So if you're looking for a loan broker, I work with Northwest Commercial Lending in Seattle, and they work all over the country. Joe Weitzel is the owner over there. I also like working with US Bank. US Bank has been great to work with, and then Bank of the West as well.
All right. Michael is asking, how do you become a broker's preferred investor? Do you offer higher commissions?
Um, it's interesting. I always joke and tell my agents that I will, pay them more for what they do. And to be honest, nobody has taken me up on that. They've never said, "Sure, pay me more." And so, okay, so becoming their favorite client. I would say number one is if they bring you a deal, give them feedback. If that deal does not meet your criteria or for whatever reason you've decided not to buy that deal, give them feedback. There's nothing worse for an agent of, going out and doing the hard work to find a deal, get excited about sending to you, and then just not hearing anything. And so if they don't hear from you, it's unlikely that they will send you another deal, right? And so that's number one, give them feedback. Number two is I would say be respectful of their time. So it's not the agent's job to do due diligence for you. It is your job as the investor, meaning you should be going through all of the due diligence yourself. Certainly, I go back to the agents and I say, well, that wasn't a T12. I need more information, or I need this information from the seller. And then the agent, of course, will go and get that information for me. But I'm not asking the agents to go and pull permits for me or figure out if we can add more units or anything like that. I'm really just keeping them in their area of expertise, which is finding great deals. And if they find me a great deal, they know that I will buy it. And if I won't buy it, then a lot of times I will refer my investor friends and say, look, I have too many projects on my plate right now, but this deal that you just sent me looks perfect for my other investor friend. Can I just connect you guys? And so those are a couple of different ways that I feel like I've become some of the agents, a best friend, if you will, and where they funnel all the deals to me.
All right. Henry is asking, do you have a good CPA and bookkeeper, or do you keep track of that yourself? or is it the
Oh,
property management that keeps track of it?
yeah. So the property management companies, they will send you operating statements, but that's not enough for you to do your taxes. And so I have a bookkeeper. She's fantastic. Again, if anyone wants any contact, feel free to reach out. But I have a bookkeeper that does our books every single month. And so she goes in and reconciles all bank accounts. She will log into all of the property management company portals, grab those operating statements, and then produce a profit and loss statement across our entire portfolio. We typically get that on the 15th of the month for the prior month. So just this week, we were reviewing January profit and loss just a couple of days ago. So that's how that works. And then I do work with a CPA out of Seattle, Mark Canton, and he's fantastic. He does a lot of cost segregation for us. So we buy a new property and he will kind of do a cost segregation study for us and help us kind of accelerate some of that depreciation. And so our bookkeeper sends the QuickBooks file to our CPA. Our CPA takes all of that and then does his CPA magic, and that's how that works. So we do not handle any of that. It's incredibly cost effective to have the experts do that.
All right. Eugenio is asking, what's the longest time it took your deal to hit your desired cash on cash?
Oh, that's a great question. It's going to depend on the deal. So sometimes, if it's already stabilized, or that Boise duplex that I mentioned, all we had to do was put tenants in there, and then it's, I would say, 30 days, right? The first rent payments. Sometimes it takes a little bit longer to stabilize. The larger units you get into, then I would say it takes a little bit longer. So this 34 unit that we're working on today will probably take, I don't know, maybe 9 months to hit our pro forma. So it's really just going to depend on the deal, but sometimes it's within 30 days.
All right. Um, Harjot is asking, do you make sure that the property you buy is empty, or do you wait until there's a tenant?
Yeah. Again, it's going to depend on the size of the property. So sometimes if it's a single family or duplex, if I'm buying it vacant, then it's vacant, then we renovate it. A lot of times I actually don't like inherited tenants on these small properties. I would say maybe call that 6 to 8 units or below. I actually like to put my own tenants in because sometimes sellers are selling today because they have tenant issues. And so I don't always want to inherit those. I had a sixplex that I bought maybe about a year ago. And in looking at the rent roll, three tenants had significant past due balances. And so I actually negotiated with the owners. I said, I will close within 7 days of you removing these three problem tenants because I don't want to deal with evictions. I don't want to deal with the problem tenants. And it took us maybe 75 days to close, but they got them out. And then of course that was our priority, was renovating those 3 units, getting my pro forma rents, and then going back to the tenants that were left over and saying, well, we're getting, I think it was like 850 downstairs and you're paying 695. And so, certainly we didn't want to kick them out, but we do some rent increases. And then as they move out, then we'll renovate. So if that helps, if that makes sense.
All right. Augusta is asking, do you have any short-term rentals in your portfolio, and how do you manage them over a distance?
It's a great question. We do not. As mentioned, my why for investing is that our rental portfolio will fund our ideal lifestyle, which means we're very hands off. We go, and it might sound like we're not hands off because I'm telling you that we're doing all these renovations, but typically, we find great teams. We give them kind of a scope of work and then let them do what they do. And so short term rentals have not fallen into that category for us. Now, certainly, we could bring on property managers and do things like that, and we might actually, with our Michigan property that we just bought, we might actually do some short-term rentals there because it's so close to the lake, and that actually is a pretty popular short-term rental area. But it's very easy for us to stabilize these, multifamily units and kind of move on to the next one. So we've chosen not to get into short-term rentals. However, I know a lot of investors that are doing it from afar and having really great success, very high returns. So I think it's a viable strategy. I've just kind of stayed in my lane, if you will.
Glenn is asking, what is your typical exit timeline on a property, or do you hold it in perpetuity?
That's a great question, Glenn. I would say, I mean, I have properties from 15 years ago that are just cash flow heavy. Maybe we've gone back and done 2 or 3 cash out refinances, and it's still, producing cash flow. And so, I would say if I had to average it out, though, we are selling our small properties and trading them into larger properties. So I would say the typical hold time is going to be maybe 7 to 10 years. When we've not really had any more opportunity to add value, or if we've hit our pro forma too soon, or if it's in an area maybe that's gone downhill, then we will sell. I just exited out of Indianapolis. That was one of the first out of state markets that we got into. And for example, 5 years of owning that property, and we had never been able to increase the rents. And so ultimately I said, gosh, we're doing better in Tennessee and Michigan and Texas and Idaho. Why do we have this one property in Indianapolis where we've never been able to increase the rents? Let's go ahead and trade that in.
All right, and here's the question that I know many guest speakers like, but Jaswinder is asking, how could we be on your investor friends list?
Deals like the Boise, Idaho. I know, Jaswinder, I wish I would have bought that entire neighborhood. I'm still kicking myself for that. So yeah, reach out. You can go to our website. You can send me an email. I'm so passionate about helping others invest. I think I actually have more fun helping other people get into deals than I am about buying my own deals anymore. Because I just love this. And to be honest, my husband and I kind of started speaking and sharing because we had achieved financial freedom at a pretty young age and started to go to our peer group and would say things like, hey, do you want to go, to Europe for 2 weeks, or do you want to go travel with us? And we kept getting this feedback from people saying, we have jobs, we need to check with HR, we can't just on a whim leave. And so my husband and I kind of felt a little lonely, I guess, on this journey of, well, we need to be able to have friends to go, explore with and adventure around with and just have fun with. And so I love sharing this with you guys, and I can put my contact information in there as well. And same thing, if you guys have questions, we have a lot of just free resources. We've got due diligence checklists that we share, some market research if you'd like that. I'm just always, happy to share, but I'll put my email here.
Put it there, and I'll also update our SharePoint site with all your contact information this afternoon.
Oh, excellent. Fantastic. So Jaswinder, the answer to that question is just reach out. I'm happy to have a conversation, and happy to share any other deals that we get in Boise, because that's a great market.
Hey, Jennifer, this was an awesome talk. Thank you for being so enthusiastic and informational, and it was great. Why don't everybody take themselves off mute and thank Jennifer?
Oh, my pleasure.
Thank you, Jennifer.
Thanks, Jennifer.
Thank you, Jennifer.
Thank you so much.
Thank you.
Thank you
so
much.
Thanks.
My pleasure. Thank you for the
Thank you.
invite.
Thank you. Really appreciate it.
Oh, my pleasure.
All right, and I hope everybody has a great 3-day weekend. Jennifer, you too.
Thank you.
Bye-bye.
Thank you. All right, all
Thank you.
take care. Thanks, everyone.
Thanks.